In the spring of 1929, the American economy appeared unstoppable. Stock prices had tripled over the previous 8 years. Ordinary citizens were investing their savings in the market, often borrowing money to do so. Financial experts reassured the public that prosperity would continue indefinitely. Few recognized the warning signs accumulating beneath the surface. The practice of buying stocks on margin had become commonplace. Investors were required to pay only 10% of a stock's price up front, borrowing the rest from brokers. This meant that a relatively small decline in stock values could wipe out an investor's entire position. By the summer of 1929, margin debt had reached unprecedented levels. The system depended on continuous growth. Economic data from the period reveals troubling patterns that went largely unnoticed. Industrial production had begun to decline in the summer. Construction had slowed. Consumer spending showed signs of weakness. Yet stock prices continued to climb through September, driven more by speculation than by underlying economic fundamentals. Several economists and financial observers raised concerns. Roger Babson, a statistician and business analyst, warned in early September that a crash was coming. The market dropped briefly after his speech, but quickly recovered. Babson was dismissed as a pessimist. The prevailing view among bankers and government officials was that the economy had entered a new era of permanent growth. The Federal Reserve faced a difficult decision. Raising interest rates might cool speculation, but it could also slow legitimate business activity. Lowering rates might stimulate the economy, but would likely fuel further speculation. Through much of 1929, the Federal Reserve maintained a cautious middle position. Records indicate that internal debates were frequent, but no decisive action was taken. On October 24th, the market began to fall rapidly. Panic selling overwhelmed the exchanges. Leading bankers met privately and agreed to support the market by purchasing shares. Their intervention provided temporary relief. For a few days, it seemed the worst might be over. The collapse resumed on October 28th and 29th. In 2 days, the market lost nearly a quarter of its value. Millions of investors saw their savings disappear. Those who had bought on margin owed more money than their holdings were worth. Banks that had loaned money for stock purchases faced mounting losses. The initial crash was severe, but what followed proved far more damaging. Rather than treating the crash as a signal to reconsider economic policy, officials maintained that the fundamentals were sound. President Herbert Hoover stated publicly that business conditions remained strong. The Federal Reserve did not significantly ease monetary policy in the immediate aftermath. As stocks continued to decline through 1930 and 1931, banks began to fail. Depositors rushed to withdraw their savings, causing more banks to collapse. The money supply contracted sharply. Businesses could not obtain credit. Unemployment rose from 3% to over 20% within 3 years. Historians suggest that the depth and duration of what became the Great Depression was not inevitable. The stock market crash itself was a financial event. Its transformation into a prolonged economic catastrophe resulted from policy decisions made in the months and years that followed. The gold standard, which many countries maintained despite economic distress, prevented governments from expanding their money supplies to counter deflation. International cooperation proved limited. Countries raised tariffs to protect domestic industries, which reduced global trade and deepened the downturn. The Smoot-Hawley Tariff, passed by the United States in 1930, was met with retaliatory measures abroad. World trade volume fell by more than 60% between 1929 and 1932. The human cost accumulated gradually. Families lost their homes when they could not pay mortgages. Breadlines formed in major cities. Rural areas faced agricultural collapse as crop prices fell below the cost of production. The crisis persisted for years, fundamentally altering how governments approached economic management. The mistake was not simply the failure to prevent the crash. Financial markets are inherently volatile. The more significant error was the inability to recognize, after the crash occurred, that conventional approaches were insufficient. Policymakers remained constrained by economic theories that prioritized balanced budgets and stable currency values over employment and output. Evidence points to a widespread belief among officials that government intervention would delay a necessary correction. The view held that the economy would naturally return to equilibrium if left alone. This perspective dominated thinking in finance ministries and central banks across the developed world. Alternative approaches existed but were considered radical. By 1933, when new policies finally began to emerge, millions had endured years of hardship. The economic output of major nations had fallen by a third. Political instability had spread across Europe. The social fabric of many countries had been severely strained. The Great Depression reshaped economic thought. It demonstrated that financial crises could spiral into prolonged downturns without active policy response. The experience led to new institutions designed to prevent similar failures, including deposit insurance, securities regulation, and more active central banking. These changes emerged not from foresight, but from painful experience. The cost of the initial mistake extended far beyond lost wealth. An entire generation's expectations were altered. Trust in institutions diminished. Political movements that might otherwise have remained marginal gained support. The economic chaos of the 1930s created conditions that historians now recognize as contributing to larger conflicts that followed. What appeared in 1929 as a temporary market correction became a defining crisis of the 20th century. The warning signs had been visible. The tools to respond existed, though they were considered unorthodox. The greatest expense was not the crash itself, but the years of suffering that followed from the conviction that the system would correct itself without intervention.